Alrighty guys, what is going up? I hope you guys are all having a great and amazing day today. Now in today's episode, we're going to be talking about how to make $100 per month from dividends. Now, dividends are a perfect passive income stream because they require just a little maintenance in the beginning and then you can pretty much get paid for life. So we're going to be breaking down pretty much my mindset on how I have that passive income and pretty much how you guys can get it too. So I hope you guys enjoy it, and if you guys get anything value, hit that like button and subscribe. And if you guys want to learn more about investing in the stock market, we do have a little course. It'll be the first link down below, and you guys can use promo code dividends to get 50% off the course. So at least check it out. So now guys, to jump into it, roll that intro, let's go. Bam! So now, like I said before, dividend investing is by far probably my favorite way to create a passive income. Like I said, it requires a little maintenance, a little capital in the beginning, and then you can pretty much get paid for life if you do it right. Now, what a dividend is, it's pretty much when a company makes so much money that they want to pay their investors. So imagine this, you guys buy a share of Coca-Cola. Now, when you guys buy a stock, you are a small owner in that company. Now, if let's say Coca-Cola loses money, most of the time that stock price will fall down. But if Coca-Cola makes a lot of money, then the stock price will go up because the company will be worth more money. Now, when a company makes so much money, they will pay their investors in the forms of dividends. Now, some companies out there have been paying dividends for years. There's what you call dividend kings and dividend aristocrats. These are companies that have been paying their dividends for years. So a company like Coca-Cola is a dividend king. They have been paying dividends for more than 50 years. Now, why this is so important is because they will have a tendency to continue to pay dividends in the future, because there's no law saying that companies have to pay dividends. It's just a little incentive companies do to actually get people to invest in the company. Now, a dividend aristocrat is a company that's been paying dividends for more than 25 years. So really, dividend kings are like the Mac Daddy, and then the dividend aristocrats are still top, dividend payers, but not as good as dividend kings. Now, to create that passive income, you will need a portfolio size of right around $40,000. And I know a lot of you are saying right now, well, Carter, that's too much money. That's too much. I can't do it. Well, you don't need $40,000 starting off. You can invest $100 a week over the next, 10, 15 years and easily hit that number. Look at the math right here. So the biggest thing about dividend investing is make sure you guys are signed up with a broker that offers DRIP. This is Dividend Reinvesting. So the reason why this is so important is because your dividends are going to be getting you dividends. And then guess what? Those dividends are going to be giving you dividends. And you'll have this thing called compound interest. You guys can clearly see right here. Look at the difference between reinvesting your dividends and not reinvesting your dividends. It's crucial for beginners to reinvest your dividends. And on top of it, you will make around 3 to 4% more per year just by reinvesting your dividends, because honestly, that's where you make so much money, is off dividend. But Carter, what do you look at for dividend stocks? What are some key pieces of information I need for picking and choosing dividend stocks? Well, there's quite a bit of stuff. The very first thing I like to look at as a dividend investor is what you call a payout ratio. So a payout ratio is a ratio to judge on how much money a company is paying out in the forms of dividends. Now, me personally, I like to invest in companies that have a payout ratio less than 60%. The reason why this is super important is because you want a company that still has leftover cash to actually grow the business. So if let's say a company has a payout ratio of 100%, on their earnings, they are going to be paying 100% of the money to dividend investors. So there's no money left over to grow the business. That's not good. If you compare this to Apple, Apple has a payout ratio of 25%, so there's still 75% of the money left over that Apple can use to grow the business. So those pieces of information are huge. The second thing you need to look at is the dividend yield. Now, you should never in a million years chase a dividend yield. Now, me personally, this is just my opinion, I would rather invest in a stock that pays a 2 to 3% dividend and is a high quality stock with an upward trend and has a lot of long-term potential, rather than a stock that pays a 10% dividend, is on a declining trend, and is losing money. As a dividend investor, that yield of 10% is very, very attractive, but you have to look at long-term goals. Where is this stock gonna be at in the next 10, 15 years? If it already has that downward trend, the trend is your friend, and most of the time that stock will continue to go in that trend. And if the stock is on an upward trend, the trend is your friend and it will continue to go up in value too. Now, another thing that I like to look at as a dividend investor is looking at the cash on hand to debt. Me personally, I like to make sure that they have enough cash on hand to pay off their debt. This is really important because if, let's say, a company slows down, you want to make sure that they still have enough money to grow the business and continue to pay the dividends. That's why these dividend kings are super large and have been paying dividends for years, because they have a ton of cash. And so if they go through a recession, they have this cash to continue to grow the business and continue to pay their dividends. So it's super important. Now, the third thing that you guys can do as a dividend investor is invest in what you call REITs. These are pretty much dividend real estate ETFs. So these companies will go out, buy real estate, and as the tenants pay their lease or their rent, you get a little bit of that money in the forms of dividends. Now, these are super attractive for dividend investors because by law, they have to pay 90% of taxable income to dividend investors, to their investors. So this is awesome because you could easily have a yield of 3 to 5% and actually have a high quality REIT that is growing and getting more money. So it's super attractive for dividend investors. Just don't go heavily in it. Now, the fourth thing that you guys can do as a dividend investor, now that you guys understand pretty much how to pick and choose some stocks, how to get a nice solid base, and you understand that you should not go after high quality yields or go after high yields really. The next thing you guys can do is to diversify with ETFs. Now, there's what you call dividend appreciation ETFs. So the reason why these are super important and honestly great for dividend investors, because you guys can invest in a ton of different stocks, but for a fraction of the cost. So if we look at VIG, this is Vanguard's high dividend appreciation ETF. So Vanguard has a ton of awesome dividend paying holdings in this ETF. So it's very, very low risk, but honestly, you have an awesome dividend payout. And this is something that you can pretty much count on to grow in the future. It's amazing. So make sure you guys kind of have a base of some of these dividend ETFs. It's super important, but it's just one thing that I recommend. Now, the last and final thing that I would recommend for all dividend investors to hit that $100 per month. Now that you guys are signed up with DRIP, you're automatically reinvesting your dividends, you're starting that snowball effect, you're not chasing yields, you're picking and choosing high quality dividend paying stocks. The next thing you guys can look at is the 3-year dividend growth. Because really, for me, I want to make sure that these companies are growing their dividends each year. Because if we look at a company like Home Depot is growing their dividends at an astonishing rate of over 100% in the past 3 years. So I can pretty much guarantee that they're going to continue to do that in the future, and the company values dividends. That's super important for me because I don't want to invest in a company that doesn't care about dividends and isn't going to grow it. Right now, Home Depot pays a dividend of around $5 per year. And what's important is they're gonna be growing that. So maybe it's $5 this year, and then it's $6 the next year, then $7, then $8. And then I have this thing called compound interest, and then I have this thing called the snowball effect, and I am just building momentum, getting my snowball bigger so I can make a ton of money in the future. But honestly, guys, dividend investing is by far probably the best way to create a passive income for yourself. And honestly, I hope you guys got something out of this video. And if you did, hit that like button and subscribe. If you guys have any questions or concerns, go ahead and ask them in the comments. But guys, the biggest thing about dividend investing is just starting off as young as you can. You guys will not regret it. Even if it's $5, $10, sign up with M1 Finance and you guys can pretty much invest in high quality dividend paying stocks, high quality ETFs, and you guys will just have a lot more long-term potential where you guys can live off your dividends. Because that's the main goal that I'm trying to do, is live off my dividends. It would be amazing. So I hope you guys enjoyed the episode, and if you did, hit that like button and subscribe. We'll see you guys tomorrow on another episode. Remember to stay happy, stay positive, and stay safe out there. We'll see you tomorrow. Take care. Bam.